Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, wish you a very happy financial year 2022-23. For those of my friends who are joining me from overseas, we in India follow a unique financial year for accounting. It starts from 1st of April and ends on the following 31st March. So 1st April being the beginning of a new financial year, I hope all my viewers and my online friends make lots of profits trading and investment wise. And this video is not an all fool's day joke. I'm very serious about what I'm going to share with you in this video. I'm going to share my thoughts as to why I would bet on India outperforming the year and outperforming the other peers in the emerging markets pack. You see, I'm going to use a 360-degree worldview method of analyzing the markets and putting forth my rationale and the method behind the madness. You see, there are four primary asset classes: currencies, commodities, equities, and bond markets. And money being fungible, which means easily moving from one asset class to the other, seeking profits. I have often told you that nothing happens in financial markets without a reason, and because these are financial markets, the reason itself is financial. And money moving out of one asset class into the other is also because of a reason, and the primary reason is profit. So money keeps flowing out of one asset class into the other, and on the bigger macro front, money flows out of one country into the other where it gets higher profits. The biggest market is the currency market, but the most important market is the bond market. And the bond market is the source of all finance, the fountainhead of all finance for the other markets. So it is how much money the bond markets collect will determine what the currency, commodity and equity markets will get for new money or seed money to push prices higher. Now, that 2022 is going to be an inflationary year is a given. I have spoken about how food inflation is likely to be roaring based on Food and Agricultural Organization's data, which is a subsidiary of the United Nations organization. I have also told you why interest rates need to go up in many developing countries. So far, it's been third world and emerging market economies that have raised rates. Once the big four economies start to raise rates, then other emerging market economies might see A, falling local currency, and B, FII outflows. But that need not necessarily happen to India, and the reason is our interest rates. You see, there is this concept called the cash carry trade, where FIIs would take money out or even go to the extent of borrowing. They would borrow money from an economy where the interest rate is 2%, and they would take that money from the 2% interest-bearing economy and invest it in an economy which is giving them, say, 6% or 7%. Why do they do that? Because they earn that spread. So when you borrow at 2% and invest at 7%, you have a gross profit of 5%. There is, of course, that currency risk which you mitigate by hedging, and there is a round-trip monetary transfer expense. But thanks to electronic transfer, the costs of money flowing from one part of the world to the other is now cut down drastically. All right. So the fear was that if the big four economies start to raise rates, many emerging markets will see FIIs pull money out because the cash carry trade arbitrage advantage will reduce. In the case of India, our interest rates, I'm talking of the 10-year benchmark bond yield, the main bond that the RBI issues to borrow money for the government. For example, day before yesterday, I was watching the screen as how a friend of mine was investing money based on my advices and videos. He called me up and said, Vijay, hey, can you help me buy some bonds? And I was basically helping him at the RBI Retail Direct GSEC scheme portal. And he bought the GS 2035 bond, the government security maturing in the year 2035. That is 13 years from now. All right. And although the face value was attracting an interest of 6.67%, the bond was available at a slight discount. So the yield to maturity was working out to 7.14%, 7.14%. Now with the government and the very fact that the bond is issued by the government of India, it is sovereign guaranteed, means government guaranteed. Unlike your bank fixed deposit, which is guaranteed to the extent of 5 lakh rupees per individual, the bond market is 100% guaranteed irrespective of the amount of money that you deploy here. So now you have the government of India bond yielding over 7.10%, depending on the price, which could fluctuate. It could be 7.15, it could be 7.12, 7.13, all right? Even if the Americans, the British, the French and the Germans raise rates, they will not be able to take it to 7.10%. India still remains a hot destination with the government guaranteed yields crossing 7% and more. Which is why FII money will come to India at some point in time, and not just portfolio investments, but even FDI will come to India. And the interest rate, if we push it up a little more, even more money will come in. But even if we do not push up the interest rates higher, the differential in the Indian bond market yields itself is so comfortable that, in the words of Warren Buffett, we've built a moat around ourselves where the interest rate differential is concerned. So even though inflation, the Ukraine war, possibility of China attacking Taiwan, possibility of the Saudis attacking Yemen over the Houthi attacks on Saudi Aramco's installation, etc., etc. Yes, the markets will correct. Yes, there will be declines. Yes, the declines might be sharp and vicious, but in relative comparison with our peers in the emerging market segment, I feel India will still remain a rank relative outperformer, which is why I'm betting my money on the Indian markets in the financial year 2022-2023. On this happy and cheerful note, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. In the comment section, good, bad or ugly, I always look forward to your feedback and help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Thank you for your patience for watching my video till we meet again in my next. This is Vijay Bambwani signing off for now. Take care. Bye-bye.